Welcome to the deep dive. We're here to really put success under the microscope, pull out the blueprints that work for professionals. Today, we're tackling something pretty foundational, building a rental property empire. How do you scale wealth this way?
Yeah, our mission today is, let's say, very focused. We want to extract the functional DNA of a real estate mogul. How does someone go from that first accidental rental to, a multi-million-dollar portfolio? It's definitely not luck. It's about building momentum, a trajectory.
Right. And the sources we've looked at, investor guides, tax stuff, interviews, they all make it super clear. This kind of big success. It isn't one magic moment. It's more like the compound effect of disciplined everyday habits.
Yeah,
So we've broken this deep dive into like three main chunks.
that's right. First, we have to talk about the mindset, the investor mindset. How successful people actually make money work for them. That's key. Second, we'll dissect the system for scaling acquisitions, finding deals, funding them, negotiating like a pro. And third, we'll get into operational excellence, the systems, the metrics, the strategies to, max out cash flow and minimize headaches.
Exactly. So for you listening, maybe you're thinking about that first buy, or maybe you're ready to jump from property 5 to 10. The analysis, it really starts in the same place. It's about shifting how you see your time and how you see your money. Let's dig into that first part.
Yeah, most people think of investing as something they do now and then. Buy some stock, maybe buy one house. But for someone building an empire, it's different. It's an ongoing state of mind. The sources really stress this shift, moving away from thinking like an employee trading time for dollars to thinking like an owner who commands capital.
I found that idea of trajectory over results really interesting. It feels backwards, doesn't it?
Yeah.
We're all obsessed with the current numbers, the net worth right now. Why does the direction matter more than where you are today?
Well, it's about sustainability, isn't it? And compounding. Success, like the research shows, it comes from those daily habits, the stuff you do consistently. It's not about some massive overnight change. Think about it. A millionaire might look successful based on their bank account today, but if they're burning through more cash than they make each month, their trajectory is actually terrible. Mathematically, they're heading down.
Right. And on the flip side, you could have someone listening who's, just starting out, technically broke, but maybe they're saving $100 every single week religiously, spending an hour learning the local market, reading financial statements. Their current result is tiny, but their trajectory, it's aimed straight at financial freedom.
Precisely. It forces you to take the long view. If your daily actions are chipping away at your foundation, it doesn't matter how good things look right now. The future is kind of predetermined. That's why investors have to be brutally honest with themselves about their daily choices. Are they actually researching financing? Or just putting it off? Are they controlling costs? Or letting things slide?
And this ties right into what the sources were calling the fundamental choice in the money matrix. Are you working for money, or is your money working for you?
That's the big dividing line. The line between, let's say, the working class and the capital class. Most people trade their time, their life energy, really for earned income. The empire builders. They prioritize generating unearned income from assets they own, like rentals. That brings in cash whether they punch a clock that day or not.
Okay, but to make that jump, you've got to speak the language, right? The language of capital. The sources hammer this point about financial literacy. Why is knowing accounting, like really knowing it, considered the single most powerful asset, more than the properties themselves?
Because your mind, if you train it right, your mind is the ultimate wealth creator. Think about it. If you don't really get accounting, cash management, how to tear apart an investment's numbers, you're just relying on other people's opinions. Agents, brokers, many partners, and they all have their own biases, right?
Yeah.
Truly wealthy. They make it a priority to become financial detectives themselves. They need to understand depreciation, property taxes, cash flow nuances better than the average pro because their analysis drives these huge decisions.
So it totally changes the job description. You're not just a property owner. You're really a financial strategist.
Yeah.
Purse. But okay, analysis is one thing. Putting it into action is another. Which brings us to commitment, execution, discipline. The sources talked about getting away from annualized thinking. What's that about? How does it hold people back?
Annualized thinking.
Yeah.
It's the enemy of urgency, really. When you look at a whole year, 52 weeks, it feels like you have all the time in the world. It's easy to think, oh, I'll make those calls next week, or I'll get that financing sorted out later. People assume time is abundant, and it lulls them into inaction, stagnation.
So the antidote is to create structure. that forces that daily, weekly urgency,
Yeah.
like focusing on shorter cycles. I think the sources mentioned 12 weeks specifically.
Exactly. 12 weeks. It's long enough to actually get significant projects done, but it's short enough that every single week feels important. It carries weight. Execution doesn't happen annually. It happens daily and weekly. If you focus on a 12-week plan, the accountability shoots way up. Miss a key task this week, like vetting those 5 properties or meeting that new lender, you feel the impact immediately. It forces you to correct course fast.
Okay, and this commitment to daily, weekly execution. That's how you build mastery, right? Can you walk us through that idea of layered improvement? Mastering one thing, then building the next habit on top.
Yeah, mastery in this context, it's not about being sort of okay at everything. It's about narrowing your focus intensely. So imagine an investor starts with just one goal, master deal sourcing. For 12 weeks, that's all they focus on, refining research, networking, getting their negotiation scripts down pat, until they can consistently find those below-market deals. Once that becomes automatic, like second nature, then they layer on the next habit. Maybe it's efficient rehab management.
Ah, okay. So they're leveraging that now automated skill of finding deals to free up brain power, to focus entirely on controlling rehab costs and timelines.
Exactly. Then maybe the next layer is mastering tenant screening and retention. It's this progressive, layered approach. It transforms someone who's just enthusiastic into a real professional mogul. Their success starts to look almost inevitable because they've consciously built this stack of high-performance habits one by one. That ensures the small efforts compound powerfully over the long haul.
Okay, so the mindset's in place. Now we need the engine that actually brings in the assets. Acquisition. Step 1 sounds simple. Buy a house. But the key to professional profit, like the sources kept saying, is buying what other people don't want, getting it below market value.
That's absolutely foundational. Profit is locked in when you buy, not just when you sell. If you pay full market price, you're basically just hoping the market goes up. That's relying on luck. A professional investor defines their success with a clear formula. It's like annual profit equals profit per house times the number of houses bought and sold or maybe refinanced. They treat it almost like a manufacturing line.
And if it's a manufacturing line, you need repeatable tools, especially for negotiation. How did the sources suggest getting that crucial below market price? What are the tactics?
Well, the core tactic, and this comes straight from professional negotiation playbooks, is you always let the seller make the first offer. Always. It anchors the whole conversation. If they start high, okay, now you know their ceiling. It gives you immediate intel on their expectations. You never, ever want to show your hand first, reveal your maximum price.
That makes total sense. Avoids bidding against yourself. Now, what about the tougher side of negotiation? The sources mentioned this I win, you lose approach. Sounds pretty cutthroat. When would an empire builder actually use that?
Right. It does sound harsh, but it's applied strategically, usually when dealing with sellers who are under serious pressure, where time is a much bigger problem for them than the absolute price. Like, think about someone facing foreclosure, or maybe a seller who absolutely has to move in 30 days for a new job. An investor might come in with a very low, firm, take-it-or-leave-it offer. If the seller's options are limited and they desperately need cash now, they might be forced to accept, even if it's below what the house might be worth in a normal sale.
So it strips out the emotion. It becomes purely about the seller's constraints, not necessarily the property's intrinsic value at that moment.
Exactly. And you see a similar dynamic when dealing with institutions like banks. A bank looking at a loan that's not performing or heading towards foreclosure, they know the alternative is often a long, expensive legal fight and maybe an even bigger loss down the road. So they'll often accept a lower offer that gets them most of their loan principal back, just to clear the problem off their books and avoid the guaranteed costs of foreclosure. It's just calculated business for them.
Got it. And that strategic buying of undervalued assets, that's the essential first step for what seems like the gold standard scaling strategy, the BRRR method.
BRRRR, yes. Buy, rehab, rent, refinance, repeat. That's the velocity model. It's how you stop investing being a slow, linear process and turn it into a compounding machine. See, the typical investor saves up, buys a house, then waits maybe years to save enough for the next one. BRRR is designed to break that slow cycle.
Okay, walk us through the mechanics.
Yeah.
Especially that refinance step. That seems to be where the magic really happens for scaling.
Yeah, the refinance is key. We have a great example from the sources. An investor finds a distressed property, maybe through a wholesaler, buys it for, say, $29,000. They immediately jump on the rehab, put $12,000 into it, maybe a new roof, update the kitchen, paint, floors. So their total cash into the deal is $41,000. They might use short-term financing for this, like a hard money loan, to move fast.
So they're forcing the appreciation by fixing it up, not just waiting for the market.
Correct. The rehab's done. Now, the property gets appraised, and because of the improvements and maybe favorable market comps, it doesn't appraise for the $41,000 they spent. It appraises for, let's say, $70,000. The investor then goes to a conventional bank or lender and refinances the property based on that new value. Usually it's something like 80% loan to value or LTV. So 80% of $70,000 is $56,000.
Wow, okay. So they pull out $56,000 in cash from the refinance. That pays off their entire initial $41,000 investment, plus any short-term loan costs. They basically have zero of their own cash left tied up in that property.
Exactly. That initial $41,000 is now free. It's velocity capital, ready to repeat the process on the very next house. Meanwhile, the $70,000 property, it's rented out, the tenant's rent payment covers the new mortgage, taxes, insurance, and the investor is likely pocketing monthly cash flow on top of that. In this example, maybe close to $1,000 a month after all expenses. They just manufactured a new income-producing asset using capital that recycles almost infinitely.
You absolutely cannot pull off that kind of speed without a really solid team, though. The sources kept saying referrals are the best way to find people you trust, agents, lenders. What makes an ideal team member for someone trying to build an empire?
Yeah, the right agent isn't just someone licensed to sell houses. You need someone with real experience working with investors. Ideally, they're an investor themselves. They get that investors are looking for value, not granite countertops necessarily. They can spot a distressed deal, an undermarket opportunity, instantly. And you need a lender who understands the BRRR pace. Quick appraisals, efficient loan processing. Not someone who takes 3 weeks to return your call. Speed is money here.
And managing contractors seems critical, especially if you're doing multiple rehabs. If you need that speed for BRRR, how do you set a professional tone that ensures they actually finish on time?
It has to be strictly professional, contractual. The sources really emphasize this. Your contracts need to spell out penalties for blowing past the agreed-upon deadlines. But it's a two-way street. The investor has to be professional too, pay promptly, pay in full when work is done right. If a contractor balks at having timeline penalties for dates they propose, that's a huge red flag. It signals they aren't confident in their own ability to manage their time.
Okay, shifting gears to the fuel for all this. Financing. Beyond banks, investors get creative. If you have self-employed income, the solo 401k was highlighted as a really powerful way to build capital. How does that work, and why is the contribution limit so much higher?
The solo 401k, yeah, it's a fantastic tool for business owners with no full-time employees other than maybe themselves or a spouse. The power comes from contributing in two ways, as the employee and as the employer. So as the employee, you can put in up to the standard limit, whatever that is for the year, say around $20,500. Then as the employer, you can contribute additionally up to 25% of your compensation.
So stacking those two roles lets you put away way more than a typical employee 401k or IRA.
Exactly. It can push the total potential annual contribution up significantly. The sources cited around $55,000 potentially. And the crucial part, it's self-directed. You act as the trustee. You can take those tax-advantaged funds and invest them directly into real estate. You could be the lender on someone else's deal or use it for the down payment on your own rental property. It allows for amazing tax deferral while you're accumulating that capital base.
That sounds incredibly powerful for speeding things up. But here's where it gets tricky, right? There's this hidden tax complexity investors need to understand if they use retirement funds with leverage. UDFI, unrelated debt finance income.
Yes, UDFI. It's complex, but absolutely vital to grasp. Basically, if your retirement account, your solo 401k, your self-directed IRA uses borrowed money, leverage, to buy an investment property, the IRS steps in. They impose this UDFI tax on the portion of the profits generated by the borrowed money. The IRS logic is, hey, the tax advantage is for your contributions, not for profits made using the bank's money.
Okay, let's make that concrete. Say I use my solo 401k to buy a $100,000 rental. I put down $40,000 from the 401k and get a $60,000 non-recourse loan inside the plan. So 60% debt financed. How does UDFI bite me?
Okay, in that case, 60% of the property's net operating income, 60% of the annual cash flow you receive inside the plan, and also 60% of the capital gain when you eventually sell it. That portion is subject to UDFI tax. It gets taxed at trust tax rates, which can be quite high, even though the asset is sitting inside your supposedly tax-advantaged account. The other 40%, the part funded by your own capital, that remains tax-deferred or tax-free, depending on the account type. You have to track this stuff meticulously. It fundamentally puts a cap on the tax-free compounding benefit when you use leverage inside a retirement plan. It's essentially the price you pay for using debt within that structure.
All right, so the acquisition engine is running, capital's recycling through BRRRR. Now the focus has to shift to running the operation smoothly. We're managing a growing portfolio. Efficiency becomes king. What strategic choices do successful scaled investors often make about the type of property they focus on?
Yeah, this one often surprises people. The really experienced investor, the one who's scaled significantly, they often tend to focus heavily on single-family houses rather than jumping straight into large apartment buildings or strip malls.
Wait, really? I mean, wouldn't multifamily offer better economies of scale, diversification across units, centralized management? Why stick with single-family houses for scaling?
Well, the argument from the sources, from experienced investors, boils down to a net benefit analysis. It centers on reducing friction. They often find that single-family houses, counterintuitively maybe, generate more profit with less overall work. And the key reason, house tenants, especially families, tend to stay put significantly longer. Years, often. The single biggest operational headache in cost and property management is turnover. That whole cycle of deep cleaning, marketing, screening new tenants, potential vacancy during repairs, it eats time and money.
Okay, so the higher stability in single-family rentals directly lowers those operational costs and boosts efficiency compared to, say, apartment units that might see people moving every year or two.
Absolutely. Every month, a good tenant stays beyond the typical churn cycle is pure profit boost, effectively. Lower vacancy, lower marketing, lower repair costs. And this stability often links back to market forces, too. Tenants often act similarly to buyers. If demand for homes is strong in an area, driving prices up, that usually means rental demand is also strong, allowing rents to rise. The single-family investor tends to capture both trends.
Makes sense. Okay, let's talk about maximizing the value of each property and critically attracting those good tenants. What are the key traits of that ideal profit-maximizing tenant? The source is listed 4, I think.
Yeah, the 4 pillars of the perfect tenant, basically. 1,
Yeah.
they pay the rent on time, every single time, no chasing. 2, they take excellent care of the place, almost like it's their own, minimizes your repair bills. 3, they stay forever, or at least for a very long time, maximizes stability, minimizes turnover costs. And 4, they almost never call you, meaning they're resourceful, handle minor things themselves, and don't create administrative drag.
That's the dream tenant. So to attract that person, you obviously need to offer a good product. What do tenants consistently look for when choosing a place?
It usually boils down to 3 main things: security, space, and condition. Is the house in a neighborhood where they feel safe? Is there enough space for their family, their stuff? And crucially, is the property clean and in good repair when they view it? That first impression is huge. Tenants are incredibly sensitive to the condition.
Which brings us right to vacancy costs. The sources had that great line, dirt costs money. How aggressive should an investor be about minimizing that time between tenants?
Extremely aggressive. Filth left by a tenant who just moved out. It's psychologically off-putting to prospective renters. It makes the unit feel neglected and dramatically slows down the re-renting process. Smart investors anticipate vacancies. They have cleaners and painters lined up before the old tenant is even out. They move fast. Think about it. If spending an extra, say, $500 on overtime for your crew gets the place cleaned, touched up, and rented in 1 week instead of sitting vacant for a month, that $500 is incredibly well spent. That faster cash flow recovery is a direct ROI boost. You paid $500 to gain maybe $1,500 or $2,000 in rent. Simple math.
Okay, what about due diligence on the property's condition? Especially thinking about that refinance step in BRRR or maybe eventually selling. How should an investor handle a major issue like a bad roof that they maybe can't afford to fix right away?
You have to control the narrative. Never leave the cost of a major repair up to the buyer's imagination, or worse, their inspector's highball estimate. A buyer, faced with uncertainty, will always make what the sources called an anxiety-based guesstimate. They'll pad the number massively to cover perceived risk.
And that inflated number kills deals or forces huge price reductions, right?
Way higher than reality, usually. So the professional approach. Go out and get a formal, written, detailed estimate for the repair from a well-known, reputable local contractor. You present that estimate to the buyer or the appraiser. It shows, look, here's the problem, yes, but it's a known quantity. It costs exactly this much to fix. It removes that anxiety premium. And conversely, if you have done a major repair, new roof, new HVAC, keep meticulous records, professional itemized receipts from a respected vendor, that documentation validates the property's condition and value to any future buyer, lender, or appraiser.
Got it. Okay, final piece on operations. As the portfolio grows, just looking at your bank balance isn't enough. Simple ROI might not cut it. What financial metrics become essential for managing at scale?
Yeah, you absolutely have to move beyond basic math and into more sophisticated financial modeling. The bedrock metric is net operating income, or NOI. NOI is simply the property's total revenue minus all its operating expenses, things like property taxes, insurance, management fees, routine maintenance, utilities if you pay them. Crucially, NOI does not factor in your mortgage payments, debt service, income taxes, or depreciation.
Okay, so NOI shows the property's profitability as if you own it free and clear, bought it with all cash. How's that different from cash flow then?
Cash flow tells you how the property performs with financing in the picture. There are usually two key cash flow numbers. Cash flow before taxes is your NOI minus your annual mortgage payments, principal and interest, and minus any reserves set aside for future capital expenses, like replacing a roof down the line. Then cash flow after taxes takes that number and subtracts your actual income tax obligation, which is where the benefit of things like depreciation really shows up. So NOI helps you value the asset itself. Cash flow tells you about the actual cash hitting your pocket.
And for investors really serious about scaling, especially using strategies like BRRR where money is constantly moving and compounding, the sources suggested simple ROI, or average annual return, isn't really the best measure.
Right. For investments where profits are being actively reinvested to fuel further growth, which is the whole point of scaling, you really need metrics that account for that compounding effect over time. The two big ones are compound annual growth rate, CAGR, and especially internal rate of return, IRR. KGR gives you a smoothed average annual return, assuming profits were reinvested. But IRR is generally preferred by sophisticated investors because it specifically accounts for the timing of all cash flows, every dollar in, every dollar out, exactly when it happened. It gives you the true, time-weighted annualized rate of return for the entire investment's life cycle. It captures the velocity.
So while ROI is easy to calculate, it kind of misses the dynamic nature, the speed and compounding effect that strategies like BRRR introduce.
Precisely. KGR and IRR do a much better job of capturing that velocity. But, and this is crucial, the sources always remind us that no single metric tells the whole story. You always need a holistic analysis. These numbers don't automatically account for risk levels or how much work an investment takes or unexpected big-picture shifts in the economy or regulations. Metrics provide insight, but they don't replace critical judgment.
Okay, this leads us nicely into the really long game thinking like an empire builder. Scaling to a multi-million-dollar portfolio means understanding forces way bigger than your local neighborhood and really using the tax code to your advantage. Let's start with the big one, inflation. How does higher inflation actually benefit a real estate investor? Sounds counterintuitive.
Yeah, inflation often gets a bad rap, especially for people holding cash or bonds. But for hard assets, like real estate, it's generally a positive force, historically speaking. When inflation runs high, yes, it tends to push up interest rates eventually, but at the same time, it also pushes up rent levels because wages and other costs are rising. And critically, it pushes up the cost of building new properties. Replacement cost goes up. So what happens? Smart money often flees financial assets like stocks and bonds, which are losing purchasing power due to inflation, and seeks refuge in tangible, hard assets that tend to hold their value or appreciate, like real estate.
So that flood of capital into real estate pushes property prices higher. It acts like an inflation hedge.
Yeah.
And meanwhile, the debt the investor took out years ago, that stays fixed, right?
Exactly. Your mortgage payment stays the same, but you're paying it back with dollars that are worth less and less over time, thanks to inflation. That's a huge, often overlooked benefit. But here's the thing. Even if property prices went completely flat, didn't increase at all, the investor is still building significant wealth just through the mechanics of the loan itself, through amortization.
Right. Explain that again. How does just paying the mortgage build wealth structurally?
Amortization is simply the process where each mortgage payment gradually pays down the principal amount you borrowed. The rent money collected from tenants is used to chip away at that debt month after month, year after year. So let's take that $100,000 property example again. Maybe you put $10,000 down. Over the typical 30-year loan term, the rent payments gradually pay off the entire $90,000 you borrowed. Even if the house is still worth only $100,000 after 30 years, you now own it free and clear. You've effectively turned your initial $10,000 investment into $100,000 of equity just by letting the tenants pay off the debt.
That's essentially a 10x return on the original down payment just from paying down the loan.
Exactly. And if you actually calculate the return just from that $90,000 in equity created through amortization against your initial $10,000 over 30 years, it works out to a compound annual growth rate of roughly 8%. That 8% return is basically baked into the structure of owning leveraged real estate long term, completely separate from any potential price appreciation. It's pure patient wealth creation driven by debt paydown.
Okay, let's switch to tax strategy. This is huge for scaling. The source is universally called depreciation, the investor's best friend. Why is this paper loss so incredibly powerful?
Depreciation. Yeah, it's amazing. It's an annual income tax deduction the IRS lets you take for the presumed wear and tear on the structure of your rental property, not the land, just the building. Even if your property is perfectly maintained and actually appreciating in value, you still get to deduct this depreciation amount each year. It creates a paper loss on your tax return. So you might be collecting positive cash flow checks hitting your bank account every month, but for tax purposes, you might show a loss because of this large depreciation deduction.
So it's basically like
But
government-approved phantom expense. You're deducting money you didn't actually spend out of pocket that year on wear and tear.
that's a good way to put it. And this paper loss does something incredibly valuable. It shields your actual cash flow from being taxed immediately. It can significantly lower your overall taxable income from the rentals, sometimes even eliminating it, boosting your after-tax returns dramatically. This is a key differentiator between savvy investors and amateurs who don't utilize it.
And the ultimate tool for keeping that advantage going for perpetual growth without triggering taxes seems to be the 1031 exchange.
Oh, absolutely. The 1031 exchange, or a like-kind exchange. This allows an investor to sell an investment property and defer paying all capital gains taxes, and also defer the depreciation recapture tax they'd normally owe, provided they reinvest the proceeds into a like-kind replacement investment property of equal or greater value. The tax liability essentially just rolls forward into the new property.
Okay, but the rules are strict, right?
Yeah.
Especially the timelines. What are those critical deadlines investors absolutely have to hit?
It's extremely strict, non-negotiable deadlines. Once you close the sale on your old property, the clock starts ticking. You have exactly 45 calendar days, weekends and holidays included, to formally identify potential replacement properties in writing, usually up to 3. And then you have a total of 180 calendar days from the day you sold the original property to actually close on the purchase of one or more of those identified replacement properties. Miss either of those deadlines by even one day, the whole exchange fails. All the deferred gain becomes taxable immediately in that year. That's why seasoned investors treat these 1031 deadlines with religious discipline. They call it swap till you drop, because there's no limit on how many times you can do this over your lifetime.
That's the engine for truly long-term tax-deferred compounding. Amazing. Okay, one last tax point before we move to market dynamics.
Yeah.
The home office deduction. Lots of investors manage properties from home, but might be scared to take this, fearing an IRS audit. What's the reality?
Yeah, that fear is mostly a hangover from decades ago. Back when working from home was unusual, maybe it was more of a red flag for the IRS. But the sources make it clear. Times have changed. Millions of people work from home now. If an investor genuinely uses a specific part of their home exclusively and regularly as their principal place of business for their rental activities, it's a perfectly legitimate deduction. The IRS has even simplified the rules for claiming it. Don't leave legitimate deductions on the table just because of outdated audit fears. Track your expenses, meet the criteria, and take the deduction.
Good advice. Okay, finally, let's zoom out to market dynamics. Where you buy is obviously fundamental to long-term success. We need to understand how cities are changing. There was that huge historical trend after World War II, right? Decentralization out to the suburbs.
Right. That whole mid to late 20th century was defined by the rise of the car, highways, and companies moving factories and offices out of the dense cities. It created this massive suburban expansion areas where people often didn't live or work in the traditional downtown core anymore. And this era really cemented the dominance of single-family zoning, low-density development across huge parts of metropolitan areas.
But the research we looked at points to a more recent and pretty powerful counter-trend, demographic inversion. What does that mean, and where should empire builders be looking now because of it?
Demographic inversion describes the trend, really noticeable in the last couple of decades, where more affluent households, buyers, and renters are choosing to move back into cities, into neighborhoods that might have been neglected for years. They're valuing things like walkability, shorter commutes, access to culture, restaurants, the density of urban life. This signals huge opportunities for investors in those up-and-coming urban core areas that are now seeing reinvestment and revival. Developers are responding too with more mixed-use projects.
But this desire for more density often clashes with those old zoning laws you mentioned, right?
Right.
That seems like a major barrier.
It's a massive constraint on the market and a key driver of value. Property value is intrinsically linked to what you're allowed to do with the land use. Zoning regulations in countless U.S. cities severely restrict density. The sources pointed out that land zoned for high-density housing apartments, multifamily often makes up only a tiny percentage, maybe single digits, of a city's total land area. Meanwhile, vast areas are locked into low-density single-family or two-family zoning, often based on rules created generations ago.
And those original rules were sometimes based on pretty uh, protective arguments about single-family neighborhoods, weren't they?
Historically, yes. Some of the early legal justifications for strict single-family zoning literally argued that apartment buildings were like parasites that would damage the character and property values of detached homes. That kind of exclusionary mindset, baked into zoning codes for decades, still shapes development patterns today. It prevents the market from easily supplying the denser housing that this demographic inversion trend is now demanding, which in turn artificially inflates the value of the existing housing stock, especially the low-density homes, benefiting those who already own property in those constrained areas. Hashtag outro.
Wow. Okay, so this deep dive really shows that building a rental property empire isn't about some secret handshake or finding one magic deal. It's much more about methodically implementing a disciplined system across really three core areas.
Exactly. It starts with that crucial mindset shift, thinking like an owner, focusing on trajectory, making sure your money is working for you. Then you need the systems like BRRR to recycle capital efficiently, maybe turbocharge initially with tools like a solo 401k.
And then protecting and growing that portfolio long-term means optimizing operations, managing tenants and turnover effectively and critically, leveraging the tax code. Using things like depreciation and the 1031 exchange to shield gains and keep compounding that wealth. It's about building a sophisticated, almost self-sustaining financial machine.
Yeah, at the end of the day, the path really seems paved with financial literacy, understanding the numbers deeply, and just consistent, disciplined execution day after day.
And that brings us to our final provocative thought for you to chew on as you continue building your own empire. We've talked about the power of the 1031 exchange for deferring taxes on investment properties, potentially forever. We also touched on the primary residence exclusion, how you can exclude up to $250,000 or even $500,000 of gain from taxes when you sell your personal home. So, how might a truly sophisticated long-term investor strategically combine both of these powerful tax rules? Could you potentially use a 1031 exchange sequence over many years, and then under specific IRS rules, convert a final investment property into your primary residence for a period, potentially allowing you to utilize both the deferred gains from the 1031s and the primary residence exclusion for an ultimate, largely tax-free exit? Something to definitely explore as you level up from amateur investor to professional mogul.